go ahead and attack the Lily's Loving Laundry question. So what we have here is a traditional capital expansion that should lead to marginal revenues. So as we read the problem, the key thing starts here with the assumption that there are currently 10,000 shirts that are laundered. But the marginal part of it is, although each shirt costs $4, only 75% of the shirts that we currently launder are going to be eligible for this pressing related to the capital asset investment. Those 75% of our volume shirts will each generate a marginal then revenue of $1.20 per shirt. Now, in order to be able to get that revenue stream, we need to hire one worker. And that worker up above was told that they would get paid a $9.50 per hour baseline compensation, that then we agreed that they would get a raise each and every year for 50 cents. So we can go ahead and do a simple calculation up here and just project then in year 2, then they would make $10. And if we kept that steady stream of raises and copy and paste our formula, by the end of the 5th year, they would be making $11.50. Along the way, the problem suggests that they only need work 5 hours per week, and they only work half the year, 25 different weeks, and that's a constant assumption that we can make as well. There's nothing that the problem suggests around SG&A, save for possibly this $13.50 about draperies, but it was, I think 3 years ago. The key again here is marginal. That expense existed previously. In economics and finance, we would call it a sunk cost. So we don't include it because it's not new. We only worry about cash flows that would be created in the future as a result of this. I don't see any interest expense being labeled up here, but there will be costs related to the $8,200 for the steamer, which is a capital asset, and that needs to be then depreciated. There's also a $6,000 that is reconstruction costs. So I labeled this balance sheet, and let's put down here then that $6,000 would be the cost to redo the space, and then the steamer itself is $8,200. According to the problem, it will depreciate to a $500 salvage value within 5 years. So it's a useful life of 5 years, depreciating down to $500. To keep it simple, we will use a standard straight line depreciation where, as you learned in financial accounting, if you take the steamer's cost, and we're going to fix that since it stays constant, minus its salvage value, which we're also going to fix since it stays constant, and then divide it by its useful life, which we'll also fix and stay constant, gives us that $15.40 as our depreciation. And notice, because we made it all constant, it's constantly going to refer to those same numbers. And then, as usual, we're going to have to deal with some taxes up here, and the tax rate's going to be 30% constant throughout those several years. I do make it a variable in here as opposed to over here because there's a chance this could change. What if we hire a good accountant who figures out how to save us in tax? So now let's put it together into step 2, which is the income statement. So if we have 10,000 shirts, of which 75% of them can be laundered at a marginal new price for the steaming service of $1.20, gives us $9,000. Cost of goods in this case is going to be the cost of having the employee doing the steaming. That employee is just one who will make $9.50, working for 5 hours a week for 25 weeks a year. And that's going to go ahead and give us the direct costs of running the steamer so that our gross profit, when we take our revenues minus our cost of goods, is $7,800 and change. We have no SG&A, but it doesn't hurt us to point up to SG&A here, which has a 0 value. In the event that we did need to take on some more costs, we could always model them in the assumptions and it would flow through to the bottom, giving us then an EBITDA equal to our gross profit. The depreciation will go ahead and pull in as the $15.40. We get to EBIT, which is again another subtotal of EBITDA minus depreciation. And so we're looking at 6272 as EBIT. Go ahead and pull in our interest, for which there's none, but again, it doesn't hurt us to model in a zero in case something changes. And then EBT is again another subtotal. So we're looking at that same 6272, which now needs to be taxed. So we take that 6272 earnings before tax, and to calculate the tax dollars, you use EBT multiplied by the tax rate, and that will give us the 1881.75, for which our bottom line then, EBT minus tax, suggests that this is a profitable proposition in so much as our net income should increase by about $4,400. We can go ahead and copy and paste that across for the 5 years, and we notice immediately that there is a problem in the way that we do this. So the problem is up here, never extended our assumptions on our revenues. Once we do that, then it fills itself in. And now I look across the bottom, I see, looks like there's a problem with my net income. Aha, maybe it's because I didn't extend my cost of goods formula right here. I forgot to put that there was going to be one worker. Now that I've gone ahead and diagnosed and I see that I do have a decline in net income, does that make sense to me over time? Yes, indeed it should, because the wage rate is increasing while the revenue stream stays the same, so I would expect to see a lower net income in the end than I would in the beginning. Let's pull it all together and model it like we would in finance then. First thing I always like to think about is, what does it cost to kick off this project? You need to make an investment, which is going to be a cash flow out in period 0, which is equal to the reconstruction cost plus the steamer costs. And in any given period, your cash flows net are equal to the in minus the out. But in finance, we're always concerned about the present value. So what is the present value of making a $14,200 investment right now? With a rate of 6%, which I need to add, it was given in the problem, I forgot to type it in, but it can always go back. That rate's not going to change, so I'll fix the reference. But this is the present value in period 0, which I'll leave as a relative reference. I'll skip over the payments and get to the future value, which is cash flows net. And thus the formula returns for us the present value of a $14,200 cash flow net right now would be $14,200. But in order to make NPV and IRR work, I'm going to switch the sign right here so that we trick Excel into saying the present value is actually a cash flow out. This is the amount of my initial investment. The reason I make an initial investment right now is for the presumption then that I should get in the future, as my cash flows in, all these brand new revenues. But those revenues are dependent upon operating costs, which will continue through the life of the project, where those operating costs would be the cost of goods plus any SG&A plus any interest plus any tax. Those would be the hard cash flows out associated with continuing to generate the revenues by operating the steam press and having a person run it and paying the tax on the benefit. Cash flows net continue to just be the in minus the out, and we can see that we get a slightly declining amount of cash flows net over time due to the constant revenues, but the increase in the wage rate. Let's go ahead and copy and paste the formula over for present value to make sure it worked. In year 5, I am looking at no rate, and therefore my present value and my cash flows net are equal. It's never a good sign, so let's make sure we get our rate in here, and lo and behold, the present value of cash flows net of $57.55 that come in 5 years at a rate of 6% is actually down to $4,300. And I often like to just go through and look and make sure that I've got all my references pointed appropriately, so that, for example, I'm switching the sign on a rate of 6% in 2 years when I'm looking at the cash flows net of $58.87 and coming up with the $52.39. So how do we go ahead and get our NPV and IRR here then? The NPV will just be the sum of all the present values. And the way you think about it is, if you originally spend $1,400, you generate then benefits equal to over $24,000 over time, but on a present value basis. So if you bring in 24 and it only costs you 14 to get it, it's a positive NPV of over 10,000. But the way that the world talks about this is often in IRR terms. So we use equals IRR, we point to our cash flows net, and then we can say that the returns for reconstructing our space, installing a new steam press, hiring a person to run that press, and offering a new service to our clients where their shirts can be both laundered and steamed will return us a 30% rate of return compared to the 6% rate of return that we think we could have earned in an alternate investment. And so your advice would clearly be to this business run operator of Lily's Loving Laundry to make this investment because it will yield them a positive investment gain.